Welcome to the Riskwiser Zone. I'm your host, Lewis, and we're glad you're joining us today. We've got a packed show for you, filled with insights and analysis from the world of stocks and finance. To start off, let's dive into some breaking news that's been making waves in the global trade landscape. The United States has just implemented new tariffs on goods imported from numerous countries, including Brazil, Switzerland, Canada, and India, among others. These tariffs range from 15% to as high as 50%, depending on the country of origin. Now, this move is part of a broader tariff strategy employed by the U.S., which also includes national security-based sectoral tariffs on items like semiconductors, pharmaceuticals, autos, and steel. The goal, according to the administration, is to protect American industries and generate significant revenue for the federal government. But what does this mean for consumers and businesses? Well, it's likely that prices will rise for certain goods as companies pass on the increased costs to their customers. We're already seeing evidence of this in the data, with costs from the tariff war mounting for a wide range of companies, including household names like Caterpillar, Marriott, and Yum Brand. It's worth noting that some countries, such as the European Union, Japan, and South Korea, have negotiated framework deals with the U.S. to reduce their base tariff rates to 15%. However, others, like India and Canada, are facing much higher duties, which could lead to significant disruptions in trade flows. As we try to make sense of these developments, it's essential to consider multiple perspectives. On one hand, proponents of the tariffs argue that they will help level the playing field for American businesses and create jobs. On the other hand, critics warn that they could spark a global trade war, leading to higher prices, reduced economic growth, and potentially even recession. Here at the Riskwiser Zone, we're committed to providing you with balanced and unbiased analysis, helping you navigate the complexities of the financial world. We'll continue to monitor this situation closely and bring you updates as more information becomes available. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of economics and politics in our middle segment today. A story that's been making waves globally involves the US dollar's performance and its potential implications on the global market. Recent data shows that the dollar has weakened against other major currencies, largely due to expectations that the Federal Reserve will cut interest rates. This move is anticipated to boost economic growth, but also raises concerns about partisanship influencing key U.S. institutions, such as the Labor Department and the Federal Reserve itself. President Donald Trump's decision to fire the official responsible for labor data he didn't like has sparked controversy, with many questioning the independence of these institutions. The focus now shifts to his nominations for the Fed's Board of Governors and the next chair of the central bank, which could significantly impact monetary policy decisions. Market analysts point out that political risks surrounding the US dollar are increasing, compounded by weak data coming through. The dollar index has edged up slightly but remains under pressure, while the euro found support ahead of anticipated talks to end the war between Russia and Ukraine. It's essential to consider these developments in a balanced context, understanding both the potential benefits of monetary policy adjustments and the risks associated with political interference in economic institutions. As we navigate this complex landscape, it's crucial to stay informed about global events and their implications for financial markets. The situation underscores the interconnectedness of economics, politics, and international relations, highlighting the need for a nuanced approach to risk management and strategic decision-making. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We've had a great conversation so far, discussing various topics that impact your investments and financial decisions. As we wrap up today's show, let's take a look at some news from the mining industry. McEwen Inc., a company led by the renowned Rob McEwen, has recently reported its Q2 2025 results. The company is aiming to double its gold and silver production by 2030, an ambitious goal that could have significant implications for investors. According to the report, McEwen Inc. has made progress in its efforts to increase production, with a focus on sustainable and regenerative mining practices. The company's commitment to achieving carbon neutrality by 2038 is certainly noteworthy, as environmental concerns continue to play a major role in the mining industry. However, it's essential to remember that investing in the mining sector comes with inherent risks. Fluctuations in commodity prices, geopolitical uncertainties, and operational challenges can all impact a company's performance. As we analyze McEwen Inc.'s Q2 results, it's crucial to consider both the positives and negatives. On one hand, the company's growth plans and focus on sustainability could attract investors looking for opportunities in the mining sector. On the other hand, the risks associated with achieving these goals should not be overlooked. Ultimately, as an investor, it's vital to conduct thorough research and assess your own risk tolerance before making any decision. It's also important to stay up to date with market trends and news that may impact your investments. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.